We'll start with the economic data from the past week. And if I had to pick a theme for what we see last week, um, I wouldn't say strong. I'm going to say divergent because different points are telling what seems to be different stories. Usually, if you're looking at a bunch of data and you have a trend in the underlying economy, you can triangulate around that data or with that data, and they'll all be sort of leaning in the same direction. These are not. So either sample sizes have gotten very, very small so that your standard errors have widened, which would make the process still valid, but your results rather unreliable. Not unreliable from the process, but from a statistical sense that the 95% confidence interval would be so very wide as to possibly even include zero. I'll point out the divergences as we get to them, and some of them I just don't have the math to figure out how you get the result that you do. The other side is that it's not a statistical artifact that we have divergence, but maybe it's intentional. I would not put it past this administration to push numbers around so that it tells a compelling story. I almost hate to go in that direction because it sounds almost, conspiracy theory thinking. But if you were going to manipulate things and you didn't know what you were doing, you would leave big footprints, big divergences, so the data fits that story as well. I'm more likely to give more weight to the statistical process than the manipulation, but I don't give zero to the manipulation. Let me go through this and I'll show you where the divergences are happening. Let's start with early, and I'll go in order throughout the week. Early in the week, we got ISM manufacturing. 2 days later, we got ISM services, which are midway through the screen. ISM manufacturing PMI came in at 54. Above the 52.7 from the prior reading, and even above consensus, came in very strong. Manufacturing employment 48.6, still below that 50 point, but above the 46.4. Construction spending, which is not part of ISM, it's just a different release that came out, 0.4, up 0.4. The previous month was revised to a stronger up 0.2. The expectation for this month was 0.2, so that both ISM manufacturing and construction spending came in above expectations, and they're consistent. If you have construction spending, you're going to be using physical things to build things. Well, those physical things had to be manufactured, so those two things seem to agree with each other. New orders, 56.8, up from 54.1. And prices, 82.1. This is for May now. Right, this is well into the shortage of oil on a daily basis, not the shortage of oil globally, because you had elevated stocks to begin with. We're drawing down those inventories, but the river of oil is dried up by about, rough estimates are about 12, 13 million barrels a day. So if you think that, well, this is going to find its way into prices, it tends to find its way into things that are heavy because manufacturing is much more energy intensive, and moving that stuff around also requires a lot of transportation, which is energy intensive. But look at what we have. Prices for May, 82.1. The month before was 84.6. The expectation was, well, it's going to be higher, right? Came in at 82.1. Doesn't match the inflation narrative that seems to be gripping the market. When we look at the productivity numbers on the next screen, we're going to see unit labor costs are well below 2%. Doesn't match what we're hearing and what we're seeing, especially in PPI. It seems rather divergent. Now, ISM is private, so I don't question ISM. I think we're seeing what we should be seeing in ISM. JOLTS. Here we have a divergence. Openings, 7.6 million. This is for April. The month before was revised up to 6.887. That's an increase of 10.6% in 1 month in job openings. That's incredible. If you go back to April and look at the number of unemployed, it was 7.307 million. So the ratio of openings to unemployed is 1.04, meaning there's 1.04 jobs for every unemployed person. That doesn't mean they can all go out and get those jobs. These jobs may be looking for unicorns. I know when I had markmeldrum.com, when I owned it still, you had standing job listings looking for IT people with all these incredible qualifications, just in case one came along. But you weren't really looking for one, but if you found that unicorn, you certainly would hire them. So maybe this is just a bunch of unicorns, listings for a bunch of unicorns. So there's probably a mismatch between what is being asked for and who are on employment, the skills that they have. So it's not really 1.04 jobs per unemployed. You would have to match the job openings with the skill set of the unemployed. That would probably be much lower. Quits dropped 5.15%. That is a divergence. Typically, when you have a stronger job market or the job market is improving, individuals feel more confident in quitting their current job to go get another job because the opportunity set is larger. So if you don't like the job you're in, maybe you get to a point in the day where you say, you know what, I don't need this. I can go get another job. I know I can. If you have the number of jobs that are increasing, you have manufacturing, ISM manufacturing employment higher than the month before. Let's just jump down to services. Employment, kind of just on par, but sort of the same. You would naturally expect that the quits rate would increase, but it went the other way, suggesting that most people think it's a much tighter job market. That is a divergence. ISM services, 54.5, beat the month before and beat expectations. Factory orders, that's not part of ISM. It's just thrown in there, much like construction spending ends up being in the middle. We can blame trading economics calendar for not ordering them right. 4.8% on factory orders. This is for the month of April. Expectation 4.6. The previous month was revised up to 1.8. So you have a positive revision for March, and April came in way above expectations. Ex-transportation, however, 1.3 was lower than the month before. Let's get back to our ISM. Current, there's a current and forecast business activity, 57.7, higher than the 55.9. Employment, you can call that unchanged, even though it's down. It's too small to really matter about. I'd call that unchanged. New orders, 57.3, up from 53.5. And prices, 71.3, up from 70.7, up a little bit. Here's another divergence. Challenger job cuts, up 97,000. This is the highest May total since 2020. Previous month was 83.387, so an increase of 14,000 over the month before, and this is for the month of May. AI is the leading reason given. The denialists keep saying it's AI washing, is that all these layoffs blaming AI is just, they're lies. They're just companies resizing and saying, oh, let's just blame AI instead of saying we overhired. Maybe a company here and a company there, but all of them? Everyone's lying? No one's losing their job to AI? I don't believe that. AI was leading reason given, 38,579, highest monthly total ever. May layoffs due to AI. Challenger gives us a nice chart, 2023 AI given as the reason, 4,247. 2024 tripled to 12,742. 2025 400% increase, a little over 400% increase to 54,836, and we're already at 87,000 just for the first 5 months. So if this continues on, you'll be somewhere over 200,000 for the year, which is another 400% increase over 2025 if we continue on at this pace. And that's just, I'm just flatlining this for the rest of the year, saying the rest of the year will have the same pace as this, with May being the highest month ever. I'm sure we'll beat that sometime in going into the end of the year. So you could get high as 250, 275, meaning 500% increase over 2025. So this is a bit of a divergence as well. You have job cuts increasing, but job openings increasing. However, people are getting a little bit more concerned about their job. Okay, initial jobless claims increased to 225,000. The week before was 212. Expectation was for 213. This is for the week ending May 30th. If we just make the simple assumption of 4 weeks in a month, you basically have about 900,000 at a run rate of 225, 900,000 people per week showing up for initial jobless claims. And that is 1 month. If you multiply the 225 by 52, you get 11,700,000 people. That's a run rate of 11.7 million people per year showing up for initial jobless claims. There is a lot of churn in the job market every single month. There are a lot of, even though we only see, as we get to the non-farm payrolls, 172,000, we think 172,000 jobs created. There are actually many more than that, because you have a lot of people retiring every single day. Roughly, I think we're down to about 9,000 or 9,500 from the 10,000, but it is dropping. You have that retiring every single day. So over the course of the month, you have quite a lot of people that are retiring. And you have new jobs that are being created altogether, and then you have a lot of eliminations from jobs as well. So the churn is very, very high, and what you're seeing is just the net increase or the net decrease. Let's get down to non-farm productivity and unit labor costs. We had Q1 GDP downgraded from 2% to 1.6%, and this is for the quarter. Productivity as a result is just a calculation. We don't observe productivity, we calculate productivity. And if you have GDP that is dropping, your productivity measure should be lower. And it is. 1.6 dropped to 0.3. This was Q4. Dropped to 0.3. The expectation was 0.5. We should have a lower read. Actually, I don't know if that's Q4, if that was the previous reading from Q1, now that I think about it. You should have a lower read if it drops. But if productivity drops, it tends to push up unit labor costs. But lo and behold, unit labor costs actually came in lower. The expectation was for 2.5. That would have been right. If you have lower productivity, you will have higher unit labor costs. Well, we got lower productivity and lower unit labor costs at the same time. That's a divergence. Now, that is a mathematical calculation. I don't have the arithmetic to make that happen. If somebody has the arithmetic, maybe you just stick a negative sign in front of one of the variables just for the hell of it. I'm not familiar with that mathematical theorem, but maybe that's what happened. But here we are, another divergence in the data. This is government data, so in one of those things where you look at and you say, somebody was manipulating the data to show lower costs. They didn't quite understand that you have to change a bunch of things so that you don't have these divergences. But that doesn't make a lot of sense, and it doesn't line up with the inflation story. Unit labor costs being up only 1.8%. Canada knocked it out of the park. Look at these numbers. Unemployment went down to 6.6 from 6.9. That's a big move in 1 month. 88,000 jobs added. Put a zero on the end of that. 880. That's the size, relative size of what the US would be versus Canada. Imagine if the US printed that, right? 88,000. The month before was a loss of jobs and a loss in the full-time category. But look at this, 154 in the full-time category, and negative 66 in the part-time category. Unbelievable. And all without changing the participation rate. So holding the participation rate steady, increasing those amount of jobs, you will get that kind of drop in the unemployment rate. Average hourly wage is 3.2. The previous reading was 4.8. Where's the inflation? This is for Canada, mind you. 3.2 for average hourly wages. And that's year over year, by the way. Year over year. Let's go to the U.S. Non-farm payrolls, 172. You had revisions, and all revisions have been negative, except until just recently. All the revisions have now been, lo and behold, positive. It's amazing how you can get rid of one person from the Bureau of Labor Statistics, and in a short amount of time, the numbers are just absolutely fantastic. March was upgraded 29,000, 214,000 jobs. April upgraded 64,000 to 179,000 jobs. This doesn't match some of the other data that we've been seeing. Another divergence. It's like, let's just make it all good, because this report is all good. 172,000. Unemployment rate unchanged. 4.3. Our participation rate unchanged as well. If you have these sorts of changes, this is another 103,000 that we didn't know we had on top of the 172 this month. 200,000. You're telling me you're not going to budge the unemployment rate? Average hourly earnings 0.3. Actually, if you annualize that, it's 3.92%. This the 3.5 level is a level that the Fed feels is consistent with 2% PCE. We're 3.92 on average hourly earnings. Now you can always get average hourly earnings up by eliminating. Remember what I said? There's a lot of churn under the surface, right? If you eliminate a lot of the low-paying jobs like warehousing and data centers and customer service, things like that, if you eliminate those and you add AI engineers, you can give the illusion that you have wage inflation, but you're really just changing the mix. Now, if you have 172,000 jobs, you might say that's not enough to really change it. But remember, you got a lot of churn under the surface every single month. You're talking in the order of millions. So if you eliminate 3 or 4 million low-paying jobs and you add 3.2 to 4.2 million higher-paying jobs, you will get average hourly earnings increasing. But that does not speak to wage inflation, because perhaps those higher wage jobs are getting hired at a wage that would be maybe less than what they would have gotten 2 years ago, but certainly higher than the jobs that are being replaced. So I don't know that we can read too much into average hourly earnings and say there's wage inflation, because you must consider the mix. I've made this point before. The real measure of wage inflation is, I think we get that later this month. The cost index, the ECI, the employment cost index. I think, what month are we in? We usually get it the last day of the month. I haven't scrolled to the end of June in the calendar to see, but that is the true cost, because it holds the job constant and looks at the change in wage on the job. This mixes the jobs with the mix of the job, so I wouldn't read too much into that. Average weekly hours unchanged. This is sort of a divergence as well, that if you have ISMs increasing, if you have new orders increasing, if you have the employment, the job openings increasing, you would expect to see that companies would be using their employees longer in the week, but they're not. 34.3. Not so much a divergence, but you'd call it, from a triangulation perspective, an inconsistency. If this were 34.4, I'd say, well, okay, that's leaning in the same direction as some of the other data, but here it is, 34.3. Unemployment, 4.3. But considering the revisions in the jobs, no change. Considering the increase in JOLTS, no change in average hour in weekly hours. There's too many of these Government payrolls, 52. So that's more taxpayer money going to support the government. That's more taxpayer money going to support the economy. 52,000 payrolls. 52,000 households now heading to the mall to spend all that money. And 52,000 people multiplied by what they're being paid added to the deficit because you simply don't have that money. Manufacturing only up 7,000. Expectation was for 2, so that was all right. 120,000 on private versus 177 the month before. The expectation was for 85, and UI 8.1 down from 8.2. Total jobs in the economy are 162.771 million out of a population of, I think it's pushing close to 400 million, 162 million. The participation rate being 61.8. That's the working age population, not the total population. Some of the other points in here, the household suggested 149,000 jobs were created. So it is one of the rare times where they sort of both agree. Labor force increased by 83,000. Again, here is another divergence. If the labor force increased by 83,000 and you have more than double that got jobs, how come the unemployment rate is not moving? Right? Now, you would expect this. And this is, quite common, and usually this is where people who fudge their data in academic papers get caught, as they start pushing numbers around. You can't push one number or two numbers because it'll create a divergence in your data set. And those are footprints of manipulation. So you can't just push one or two numbers, because you look at, you have to publish certain outputs. Your variance covariance matrix is being published. You can't just push a number around. It's going to be obvious that something happened there. And if you're pushing around one of your betas to make it look like it's more significant than it isn't, and you're publishing your variance covariance matrix, everything can be recovered from that. Manipulating that is brutally hard to be consistent with what you just pushed around. So if you don't know what you're doing and you're pushing things around, you create divergences. And I don't know, I don't want to go there, but the divergences here. So when I looked at the household, I said, well, how much did the labor force increase? 83. I said, well, hang on a second now. That's inconsistent. I don't have the numbers to make that work. Establishment 172, government was 52. This is from the establishment survey. Government 52. Goods producing added 28,000. Services added 92. Construction added 17,000 of the 28. So there must be something going on in construction. That is consistent with construction spending coming in at 0.4 versus 0.2. IT and financials lost 24,000. This is consistent with Challenger Gray layoffs. Healthcare up 47,200. Of the 92 in services, more than 50% of it is healthcare. And leisure and hospitality, 70,000. I say to myself, 70,000 leisure and hospitality. I don't know what kind of jobs those are. Diffusion index is total 54.4, 53.5, meaning of all the industries, more likely they are expanding employment. Manufacturing itself expanding employment. It's above 50. Okay, not a good week in equities. Not a good week in bonds. Not a good week in metals that we'll soon see. It just wasn't a good week anywhere. The long end of the curve just added almost another rate hike on the 2-year, up 70 basis points since the beginning of the year. The 5-year for your car loans up 56 basis points. So you have already tightened monetary conditions. 1.5 points or 1.5 rate hikes on housing. So this idea that Warsh is going to have to raise rates, the market already has. I've made this point again and again. So I expect no change at the first meeting. Now, the idea that Warsh is not going to be able to cut rates until inflation comes down does not mean he's not going to fight inflation. But the idea that, and I can understand, you've been trained for almost 20 years now to think that the interest rate is the mechanism that you use, but he has been so very, very clear on this. That I expect that in the press conference or in the announcement, I think the biggest change will come from the balance sheet. They're not just going to sit and wait for unemployment to come down so that they can cut rates, for inflation to come down. They will begin to aggressively fight inflation. And based on everything he said and published and has done, it is going to be a balance sheet effect. Rather than raising the cost of credit, he will simply remove the money that credit rests on. It is the same outcome, except with one, you're relying on people to show some discipline. On the other, you're just removing it. So I do expect that will happen. I'm curious as whether or not we're going to get a dot plot, because he does want to get rid of that forward guidance, and that's the dot plot. So I don't even know if you're going to see that. And his measure of inflation is trimmed mean PCE, not PCE itself. But overall, not a good week to be in Treasuries. Dollar index up 1.14%. And the 10-year real yield we will see is up strong as well, which is a negative for almost every risk asset, especially metals. Banking index up 0.8% week over week. Meanwhile, you've had quite the sell-off almost everywhere. Triple Q's down 4.5% week over week. IWM 3%. SPY 2.5%. Utilities even coming down a bit, but and divergence here. Long end of the curve going up. IYR going up. TLT, well, that is just a function of this over here. June 5th, 2026, Trump, I will let Kevin decide on rates. He is sort of like giving Wall Street what it wants to hear, is that the Fed will have independence. But I think he knows that Warsh is pretty much of the same mind that he is, that rates have to come down, but for very different reasons. Warsh has a very a far more practical reason, a monetarist reason why rates can come down. Not that they should go down, but that they can come down. Market is pricing in 26 basis points, a full rate hike by the end of the year. I'm going to have to say that they are wrong on that one. There'll be no rate hikes. Now, I'm saying that as if it's a definitive fact. It is my firm belief, based on everything that Warsh has said, that there'll be no rate hikes. If there is a rate hike, then I have to sort of point at the guy and say, hey, this is not what you said. This is not what you led everyone to believe. What happened to inflation as a choice? What happened to we're going to change the measure of inflation? What happened to the balance sheet? What happened to removing monetary stimulus by lowering the amount of money in the system. So it would be inconsistent with everything that he said. Not that you can't be inconsistent, but ZQ's already priced in a rate hike. By Q1, end of Q1, another half rate hike as well. There's real yields here. Where's our 10-year? 10-year is up 12 basis points. You got $1. The DXY up 1.14%. You had 12 basis point increase in the 10-year. That is going to hit gold down 5%. Silver down 10%. Copper down 2%. Aluminum down. Platinum, palladium, all the metals are down. That is a combination of higher real yields and a higher US dollar is negative for metals. Break-evens have all decreased month over month. Week over week. The break-evens have decreased. Inflation expectations lower. That doesn't match the narrative. But I've said this point before. I don't think that bond traders are looking at break-evens and making their decision. I think if you're in tips, you're in tips. You have an allocation to tips, and that's what you're going to be in. You have an allocation of nominal yields, and that's what you're going to be in. So I think this is more of an artifact than anything else. Oil up slightly week over week, up 2.47%. Not much. It's still sitting 57% higher. Natural gas 13% lower for the year. And this is good news, other than for cattle, but you have, I think, an issue in Texas. Flesh-eating screwworm found in cattle, so that is just going to put pricing pressure on beef. But wheat, corn, soy, that's nice to see. Corn now negative, lower than it was beginning the year. So that is some relief. June 17th, FOMC, 96.2%. Nothing happening, down from 99.6. Doesn't seem to match what ZQ saying, but that's what the FedWatch has. I clicked refresh a couple of times saying, hey, you sure about this? I think it's 100%. I think nothing's going to happen there, but I think it's also 100% that something is going to be done on the balance sheet. At a very minimum, they'll stop adding. I think they'll probably lean towards even a slight decrease. They'll walk into this slowly, but it's not this Wednesday coming up. It's next Wednesday. It's the 17th that we will finally hear what his plan is. And maybe that changes the narrative. And it'll determine whether or not I stay in ZQ or just say, you know what, forget it. And then send my bill to Trump saying, you did this, you owe me. Summary of economic projections as well. I'm going to put a question mark there. I don't know that you get that because he is sort of against forward guidance. He has been hiring some advisors, and the names that are coming in are the same names that you find in Project 2025 on the one chapter on the Federal Reserve. So this doesn't seem like a Powell press conference and a Powell Fed where lots of guidance is given, lots of visibility on the moves, and a move, change being telegraphed 3-4 months out before it happens. That does not seem like this guy. That I think things will just happen very quickly. You may as well. You're coming in, you're brand new, and you got to make the Fed yours. You have to put your print on it and say this is what it's going to be. I don't think you're going to have a transition from Powell to Warsh. I think you're going to have just a break in the function altogether to a different level. For year end, 0.2% of a 25 basis point cut. I think it should be higher than that, but there's where we are. You've got basically 86% probability on nothing or one hike. Most of the effort is there. I seem to think that the probability should be skewed this way more, but here we are. Reverse repo, 761 million. Repo 0, TGA 845, reserves 3.045. Another thing that Warsh wants to do is get rid of interest on reserves. You have interest on reserves when you are in an ample reserves regime. He wants to go back to a scarce reserves regime, and under a scarce reserves regime, you don't need to convince the banks to leave money there by paying them. You just stop paying them. That would save a lot of money a year because you are transferring money from U.S. Treasury income, because they have a balance sheet, 6.33 trillion. This pays interest, but then they take that interest and they pay it on reserves and they give it to the banks. So the banks get Treasury interest close to it on their reserves. And those reserves are your money. They're your deposits. And the bank gets to keep that. And you get very little of that, which is why money market funds are so bloated right now. As soon as you get rid of that, and the banks aren't making money on that, you're going to see reserves drain very quickly. Reserves are going to have to find some place to go. And if you're not going to get paid from the central bank for holding them, they are going to go into treasuries. More than likely money market securities, maybe up to the 2-year, maybe. But I don't know that they're going to put reserves in the long end of the curve, because you can't take duration risk with your reserves. So they'll simply just go into money market funds, or they'll go into T-bills. And if the Treasury wants to keep the long end of the curve well behaved, it will more than likely starve the long end of issuance and issue heavily in money market securities, which still carries a higher interest rate than the average interest rate on debt, and you're still rolling over a lot of debt. For fiscal prudence sake, you can no longer count on your elected officials. The Treasury and the Fed are going to have to step in and be the adults in the room, which means much lower money market yields, which is not going to fuel inflation if you are removing money from the system and keeping the long end of the curve elevated. Because that's consumer credit. That's what you want to do, make consumer credit expensive. So there is a pathway here, but it's going to require a bold move, I think, out of the gate. It's going to be interesting. I will have my popcorn ready, and I don't know what beverage I'll use. Probably a Diet Dr. Pepper for this one. So for 3.62, was 3.51 last week. This thing moves, right? And the SOMA, this is the Fed balance sheet, $6.33 trillion. I think you're probably going to hear numbers of a target. Well, I don't even know if he'll give a target. He's not into forward guidance, but I would hazard a guess 2 trillion, 2.5 trillion can be shaved off of that. This is increased by 6.5 billion. Some of you may be saying, but Warsh is already the chair of the Fed. You said he wants a smaller balance sheet, but here it is, larger. He cannot change the balance sheet policy until there's a vote on it at the next FOMC. It must be voted on. He's not a dictator. It must be voted on, then it will change. And I think that is where you're going to see the big announcement is on the balance sheet, and probably something on interest on reserves. That one, I think you're going to have to telegraph that. You're going to have to give banks an opportunity to do something there. That's going to have to happen over a period of time. That would be a big shock. But certainly you can get that 6.33 trillion down, and it will be interesting to hear what he thinks about or what his plans are for the mortgage-backed securities that they have, because he believes in an all-treasury balance sheet. 2-point-some trillion dollars in MBS. I think you're going to see a swap with the Treasury for that, or the plans for a swap with the Treasury, where the Treasury will say, well, here's a bunch of securities with very low duration, so you can reduce the duration of your balance sheet. and we'll hold on to the MBS, and we'll let the MBS roll off. We'll take care of that. Mortgage apps for the week ending May 29th, down 2.5%. Fixed rate mortgage 6.48. Remember, at the end of February it was 5 point something. There's your 2 rate hikes on housing. Almost no move on corporate spreads. Triple C up 11 basis points, but still for the year down. For the year up 61 basis points. I was going to say down. It's up 61 basis points for the year, while everything else is tighter. Look at our economic calendar for next week. Monday is a quiet day. Well, quiet day on the economic calendar. Let's see if Friday's carnage in tech spills over. Tuesday, we have balance of trade. Now, this will be interesting for the U.S. because they were exporting oil during this period of time. It should do a lot to improve the balance of trade. The estimate here is coming in at negative 55.5 billion, still importing more than they're exporting, but down from 60 billion. You can see exports at 320, imports at 381. Right now, the estimate is that they're exporting some 5.5 million barrels of oil per day. Oof. We're going to talk about oil in a little bit. We have existing home sales. Wednesday, inflation. Core inflation consensus is 0.3. Last reading was 0.4. Year over year, 2.9 versus 2.8. It's not unrealistic, really. I mean, considering the narrative being told out there. Inflation rate for May 0.5 instead of 0.6. But look at this, the headline, year over year 4.2 instead of 3.8. There's your energy cost in there. Let's see what happens. Bank of Canada, we don't expect much to happen there, not with the jobs report you had on Friday. I don't expect to see anything there other than unch. PPI the very next day. Month over month, 1.4 was the last reading. The consensus here is 0.8, significantly lower. Core PPI 0.4 instead of the 1%. We have the regular weekly reports. We have the WASD report as well, if you're into the grains, on Thursday. And Friday, Michigan consumer sentiment. We've plumbed, I think, the lowest levels of it over some period of time. Baker Hughes used to be a thing. It's really not a thing anymore, so I don't even know why it still gets reported, but there it is. Okay, last week, Friday, ugly day, and a couple of companies got really punished on earnings. Ciena and Broadcom, really punished, and I'm going to make the case here that it was really market structure, not the performance of these companies, because the performance of these companies were rock solid. Hard to find fault. If you were looking for fault, you could find fault because there is no perfect report. But these were good. So the underlying fundamentals to these companies are solid. They're still doing business, and what's most important about all of these is they're characterized by shortages because backlogs keep increasing. This does not have the flavor of a market top. This does not have the flavor of a bubble being burst, because to get the bubble to burst, you need disillusionment, to have a broad bursting of the bubble where the trajectory from here on in would be downwards, because everyone becomes disillusioned and there's really nothing left to save the business. This is not the case, or not to save the business, but to save the story. This is not the case just yet. What we had is a reconsideration of the valuations, because, as I show you on the next screen, we did run a lot. Going into these earnings, Ciena's trailing PE was 170. Its forward PE was 90, 99. Broadcom's forward PE was 48. So they were all very richly priced. Let's just have a look at what happened. Before earnings, Ciena had hit a high of 642.08 and closed on Friday at 476, down 26%. There's your earnings damage right there. And then a sort of a rebound saying, hey, wait a minute, it's not all that bad. And then the weight of Thursday just dragged everything down. This is a 1 week chart you're looking at. EPS adjusted, everything's adjusted now, but adjusted $1.64. The estimate was for $1.46, so that was a sound beat. Last year for the same quarter, 46 cents. Talking about almost a 400% increase. Revenue growth, 40%. Gross margins, adjusted gross margins up 400 basis points to 44.9. Backlog, $7.7 billion. Increased guidance on both revenues and margins. Revenues, full year, $6.3 billion. Gross margins, somewhere between 44.5 and 45%. Their last IV, 86.6%. That is hard to let go. How do we play that volatility? I'm playing it based on points of valuation. I've got a 700 to 400 short strangle on this one, which means I sell a $700 call, I sell a $400 put. This is July expiration. I only have 5 of these. I got 28.51 per strangle. That's what that IV will give you. 700 to 400. 700, they didn't even get to 700. 642. I don't see them getting to 600 by the July expiration if they lost the 642 on these earnings. That makes the break evens on this 728.51 to 371.49. And looking at their forward earnings, I assume just 20%, just a 20% growth rate. I get to 880 on forward earnings. At 728, you have a forward multiple of 82.8. That is way too high. At 371, a forward multiple of 42.2. A little bit more reasonable. Considering the growth rate that this company is putting on and the size of that backlog. Now, not all that backlog converts to revenue, but over the next quarter, I don't see any of these supply issues being solved. I don't see any capacity coming online quick enough to get rid of that backlog. So I think we're good on this one. And if it is put to me, I'll own it at 371.49 average cost with a reasonable multiple, considering I'm giving it only a 20% growth in the earnings over the next 4 quarters. That's all. Broadcom hit a high of 498.23, and there is the earnings impact here. That was a forward PE of 48 times based on their forward guidance. They ended at 385, down 22.7% at a forward multiple of 29.6 based on their guidance. That's reasonable. That is reasonable forward multiple for the growth rate that this company is experiencing. Revenue was up 48% year over year to $22.19 billion. Look at their guidance for Q3. This was Q2. Q3, they're guiding to $29.4 billion. From 22 to 29, quarter over quarter, year over year, it's another 84% growth. Non-GAAP EPS 2.44. Estimate was for 2.4. Year ago was 158. From semis, 15.01 billion of that 22 was from semis. AI specific 10.8 billion. They count 6 major hyperscalers as their customers. That's 143% growth in AI specific semis. Operating margin much better than CIEN, 67.3. Sorry. This was gross margin here. Operating margin 67.3, which would be much better than CIEN because that was just gross margins. This is operating margin, up 200 basis points. Free cash flow, $10.3 billion. I want to stress that is a quarter. Backlog, roughly about $30 billion. Their non-GAAP gross margins, this is a bit of a problem. Their operating margins did fairly well, suggesting some good cost control and maybe some operating leverage in here, but their non-GAAP gross margins down 230 basis points to 77.1. As I said, their guidance for the quarter, 29.4 billion, up 84% over Q3 of last year. AI semis, they're guiding up to 16 billion, from 10.8 to 16 billion. 2027 AI revenue, they're expecting 100 billion just in AI revenue. This was not changed, and this was the fault that they found, that the market looked at and said, wow, you're raising this guidance, but you're not raising 2027. So some of this is just pulling forward some of the demand, but you're not really seeing an expansion. Otherwise, that 100 billion would have went higher. That finding fault with that, I think. Last IV reading 49.6. It's got lower IV than Sienna, so it's not going to pay as well, but there's still a nice trade here at the 480, 330. So they hit 498 before earnings, and then dropped to 385. So let's go to the 480. It's very close to the 498 and a 330. That's a short strangle as well. Sell a call, sell a put. You get $10.34, not as rich as the 28.51 you're getting on Sienna, but that's what volatility will do. Still $10.34. So your break even would be 490 or 320. I'm assuming a forward PE of 11. That is 10%. Only 10% growth. In other words, I'm really lowering their forward EPS just to see what valuations I would get here. At 480, it'd be 44.54 times forward earnings. At 330, 29 times forward earnings. If we use the more aggressive number, that forward multiple would be closer to 25, maybe even 24. But I specifically pulled it back, saying, okay, worst case scenario, let's say it pulls back to this, what would be the forward multiple? Owning it for 330 minus the 1034, 319.66, getting a 29 times forward multiple at a low assumption of growth, I think is not unrealistic. And given the heavy valuations we had going into this, I think I'm okay at the 480. Same with Sienna. I think I'm okay at the 700. I have done these. I've got 5 of these in play. I have not done any of these. I thought I would do the Sienna, and then Monday, if it's still ugly, if Broadcom is still selling off, I think I'll probably look at doing something there, and probably not doing a short strangle, but probably just doing puts. Okay, let's step back and look at triple Qs and the semiconductor index. Looked at 2 of the earnings within it, and you can revisit any of the companies that had earnings. They were all good in any other market. When we look at what prices are a reflection of earnings fundamentals, they all get I think an A plus on earnings fundamentals. They failed on the next two conditions. Qs, look at that. It's up 26% since March 30th. This is just a 1-week chart. We can see that you were pushing up around 750. We ended right around 700. That's quite a bit. And if you were there Friday, we were down 4.98%. And then after hours, there was another dump down. We ended down 5.5% in one day. I have to point out that is a huge left tail move. You're talking 3, 4, 5 standard deviations into the left tail on this one. I don't know how many. I haven't done the math, but you're certainly not 2.5 standard deviations. You are significant standard deviations into the left tail. You just don't see that very often. However, in 6 months, this is a 6-month chart. Over 2 months from the low to the high over here, you can see that big red bar over here at the end. That is Friday. This is a 6-month inset. I just took a little screenshot and put it on top of the 1-week chart. Up 34% in 2 months. That was too far, too fast. So investor expectations got too far ahead of reality. Companies did not only have to beat, they had to massively beat and guide. So on earnings fundamentals, as we saw with Ciena and Broadcom, I say you give it an A to an A plus. Those were solid earnings, solid backlog, solid guidance, raising their guidance. I give it an A plus. Investor expectations just priced in way more than what reality ended up delivering, even though the reality was pretty good. You also had market conditions as well, higher real yields, the 10-year adding 10 basis points week over week, and for valuations, real yields matter more than nominal yields. Because if nominal yields are way up, well, that's inflation, which means prices must be up, and companies that have pricing power raise their prices. So the nominal yield isn't as important as the real yield. The real yield is, without the effect of inflation, higher real yields, lower present values, but we have had higher real yields all over this period of time. But you have to have investor expectations sort of crushed a bit, and they were. It's like, okay, we've gone too far, and before you start paying attention to what matters again, it's like, hey, wait a minute here, real yields are up. 10-year up 12 basis points week over week. Strong jobs reports interpreted as possible rate hikes, which would push real yields higher because the expectation is it would bring inflation expectations down. The semiconductor index tells an even more aggressive story. Over 2 months, up 98%. Over this 2-month period of time, the triple Qs were up 34%. This doubled 98%. Since March 30th, it was up 74%. So yeah, there was going to be a reckoning, and this is just the semiconductor index. This is the triple Q, which has some of the same components in here. This is a more pure semiconductor index. So the sell-off we saw on Friday is not the popping of an AI bubble. It's the popping of investor expectations. That happened on Friday is that had to be corrected for. That had to come back down to earth. In other words, it's like, look below you. The real story is good, and it's rising. The real story is good. Now, all of this will end badly. All of this will end in overcapacity, but not today. Not looking at these companies that we're reporting, and all of the companies really, and the backlogs that just keep increasing, rising faster than what revenues are seeming to rise at. That is suggesting that there is still significant shortage. Add to that you have the Chinese models, which are just as good for a lot of the tasks at a much lower cost. Some would seem to think, well, that's going to be a threat to the AI story. No, it's going to be a doubling down from the American companies to say, we can't let the Chinese win. It is competition. So there's going to be even more aggression, I think, going forward. So this is not over until capacity exceeds demand. But right now, demand doesn't just turn off. It doesn't work that way. It doesn't just turn off. You need disillusionment first, and we don't have disillusionment over the story. We have it over the expectations that were built in. You look behind you and you say, whoa, 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 we got to slow down. We've gotten way too far ahead of where everyone else is. Now, you're not going to have this massive growth, earnings growth, because you're capacity constrained. You're capacity constrained in energy. So everyone else's revenue can only grow as fast as you can get energy on the spot. China has an advantage on that quite easily because they don't have somebody saying, I don't like windmills. You can't have them. They don't have somebody like that. So they'll use everything. So if I had to bet, and I do bet, and I did make some bets on Friday, I have, I think, 18 puts on NASDAQ. The July contract, the July expiration, the futures contract is NQ at the 29.3. That is the strike. I have 18 puts. I sold puts. And I think my average is about 850 per put, which would put me somewhere around the 10% correction on the July contract. the July expiration with the September underlying based on the September's contracts all-time high, it would bring me down to about a 10% correction if it were assigned to me. I'm good with that. We'll see how we open tonight, but that was one hell of a rout on Friday. And valuations are probably a little ahead of themselves right now, but this market has been trained to buy the dip, and that was a big dip. A 10% correction would actually be healthy, would not be an unrealistic thing to see. We'll see what we get, but I don't think this is over. I think we end the year higher than where we are now, not lower. Or let me rephrase that, because that is a forecast on price and time, which you never do. You either forecast over time or you forecast price. So let me change that. I think the NASDAQ finds its way to a new high sometime before the end of this year, which could mean the end of the year. But I think that we do see new highs in this, because given the backlogs, given the guidance, given the performance, given the cash flows that these companies are producing, I don't see this story as being over just yet. One of the things that held back 1999, because I thought about this yesterday and I go, well, that was a big issue in 99 and 2000, was you could not actually experience the full potential that the internet had promised. It was this big story of how it was going to change business. But there were bottlenecks at that time. One really big bottleneck was payments. The idea that you can move your business online. You had to be big to get that done. Because I had a business at the time and I thought, well, this is great. Because what you can do is you could just put your stuff on a website, and back then it wasn't dynamic. You had to take pictures of all your stuff. You had to put the pictures online. But I was in a rental business at the time. I thought, well, let's just put all the pictures online and let's have a little booking, something for booking and payment online. This would be great. Well, here's the problem with doing that. Visa and MasterCard weren't set up at that time to handle a lot of online payments. So as you're talking to them, they're saying, okay, well, yeah, we can do that, but we're going to want big cash deposits. And it's going to be 30-day settlement, because they were so worried about fraud. So for a small business, you suddenly had to post $30,000, $40,000 as security for each one of them. That you had to give them that money as security, and then you could take credit card payments online and be paid 30 days later. It was impossible to get done for a lot of small businesses. So the promise was held back by the payment system at the time. So you got disillusioned with the whole thing because you said, yeah, sure, the story sounds great, but try doing it. But not now. With AI, I don't see the constraint in place in that, well, I cannot do it. I mean, I can do it. I have not found a constraint where it goes, okay, well, the promise is nice, but I can't do it. Agent sounds nice, but it's not that I can't do it. It's just that it doesn't really work that well. But maybe I have to rethink how I architect the task that I want the agent to do. Maybe instead of one agent doing it, I need one agent to do one part, hand it off to another agent that does another part. I don't know, maybe it's something in there, but I don't have that constraint. So I don't have that disillusionment. When disillusionment shows up, then the whole thing pops. But we're not there yet. Okay, let's have a look at WTI. I do have a bet out on WTI. I have been selling puts. I've got, I think, 6 of them now. I got 3 at the 80. This is for August expiration. I got 3 at the 80. I've got 2 at the 75, and I got 1 at the 73.50. Because I don't know that we get back there in any decent amount of time. I'm going to show you, first of all, some inventory numbers here, if I can find my screen here. Let's see where we are. There we are. This is the last inventory report from EIA. This is crude oil here, and we can see Cushing over here is sitting at 22.4 million barrels, which doesn't mean there are 22.4 million barrels available. It has a capacity, I think, of 98 million barrels, but a working capacity of 78 million barrels, because there's about 20 million barrels that are considered working capital, because you can't really empty those tanks all the way down based on where the tap happens to sit, the outflow tap happens to sit, and you don't want to empty it all the way down, because while that oil sits in the storage tank, it filters out a bunch of silt and water and mud that floats to the bottom, and you can't fully empty these tanks. So the estimate is, once you get below about 20 million barrels, you start hitting operational difficulty. So operational inventories, just can call that working capital, kind of like money in your cash register. That's what you need to run your business during the day. That's what that is, about 20 million barrels. We're at 22.4. The drawdown each week seems to be about 500, 600,000 barrels. With 22.4, you got about 4 weeks before you hit your operational limits on West Texas. Which means that if somebody shows up and says, okay, give me some oil, it is, well, we don't have any to give you. How that begins to show up in the price in the futures contract, I don't know yet. Because obviously storage would be really, really cheap. Convenience yield would be very, very high. Would the futures price begin to reflect a much higher price because there is none there, or would the market say, look, everything's being loaded at Texas anyways? What do we need Cushing for? There are some refineries in and around this area that rely on this oil, and they're probably going to be in a lot more trouble. So let's have a look at where we are. This was the market before the crisis. It was already in surplus. That was the nice thing. And when you say how come oil didn't go to 130, 140, 150, is because inventory levels around the world were already elevated. We already had a surplus of oil. So those are being drawn down now. And the longer this goes on, you will have the crisis. So the window to fix this is narrow, very narrow. Iran knows this. This is their ace card, which the U.S. doesn't have one to beat that. Right now, Iran holds the cards on this one. Middle of the channel, you had this downward channel. Middle of the channel was around 57.50. And then you had an increase in anticipation that something would happen, and sure enough, it happened. And look at the volatility you're getting in here. Huge volatility, but it has been dropping. There were some nice premiums in the options on WTI, but it has been dropping almost every day. It has been dropping, so that the premiums are getting harder and harder to get. Even the contract I'm using, the September contract, sitting around $86. The $80 for August, try to get $5.25 for that. It struggled to get $5.25. I got $4.75 on these, and I had my next sell at $5.25. It wasn't getting there. It hung out at around $5 all day, because as the price dropped, the volatility was dropping just as fast, so you weren't getting any extra premium. I don't like that. So these white lines here are the strike prices on my puts. Clearing mines. U.S. military is clearing mines. The thinking is this could take up to 6 months to clear mines in the Strait. About 14 million barrels a day are shut in. There was about 20 million barrels a day that would go through the Strait, but some has been redirected. So we're down to about 14 million that is shut in. The cumulative supply loss is well over 1 billion barrels, and right now the best numbers are that given the rerouting, given that some are still getting through the Strait, there's still some getting through. It's about 12.8 million barrels a day that are not flowing through that should be flowing. So that just adds to the cumulative deficit. If you think about replenishing that 1 billion because inventories are being drawn down, some countries don't really rely on strategic reserves. The U.S. has strategic reserves in salt caverns down by the coast in Texas, I think in 4 big salt caverns. The problem with drawing down oil in salt caverns is you must pump in water to pump out oil. When you pump in water, you dissolve the salt. You actually make the cavern bigger, but at the same time, you make the pillars thinner. So you decrease the integrity of the storage tanks when you do that. So you can't really get them down to zero. And they've been drawn down about 50% of their capacity. Germany has salt caverns as well, but not the other countries. Other countries have either tanks or rock caverns, so they can keep refilling and refilling without an issue. Some other countries, the IEA members must hold, I think it's 90 days of net imports. Australia, I think, is the lowest on that one now in terms of the number of days of net imports that they have available. So you're going to have to replenish inventories at over 1 billion barrels gone. If you replenish that, you're talking about 1 million barrels of demand a day for the next 3 years just for inventories. And the oil is not going to flow. Even if the Strait open today, you're not going to get back to the same level you were tomorrow. It's going to take some time to build back up to the same level. So oil is going to be well supported for a while. Within the Gulf area, storage tanks are near full physical capacity. Once they're near capacity, all you can do is shut down the well. That is not a good thing. Forced well shut-ins risk about a 10 to 30% permanent loss of recoverable oil. And that is just simply because of the way that especially in water-flooded wells where you're pumping in water to keep up the pressure, there has to be a certain flow of the water going in. Once that stops, the water starts migrating in different places, and then you end up with stranded oil. That's why there's about a 10 to 30% permanent loss of recoverable oil, especially in mature fields on water injection. So you have about 12.8 million barrels a day off. However, the best estimates now for demand destruction for Q2 2026, the expectation is a drop of 2.4 million barrels a day globally. So 2.4 off the 12.8, you're still deficited by about 10 million barrels a day with that kind of demand destruction. And if the expectation is that the futures prices are going to have to start rising significantly because of the shortages at delivery places, the effect that has on the spot, we don't know yet. Haven't been here, so we're gonna find out a lot of things, because a spot market is a spot market. Futures are going to reflect the delivery point. WTI reflects delivery at Cushing, Oklahoma of a particular grade. But it may be more beneficial to take delivery in Texas rather than taking delivery in Cushing, right? So the spot price reflected there might have nothing to do with the futures price in Cushing, Oklahoma, but hedging is going to become very confusing to do. So here is sort of just gives you a good idea of why you can't get all the oil out. So let's say this is a tank, and here's your output nozzle. So your hose comes out here and it fills up a tanker. Let's say, well, you have what's called the tank heel. This is oil below the outlet, and at the very bottom you have water and sediment. You don't want to pump that stuff out. So working capital is about 20 million barrels. They have a capacity of 98, so that they have working capacity of about 78 million barrels. 20 is what's called a comfortable minimum. You can get below 20. Once you get 19, 18, you really start to have a problem. Also, heading over to the straight opens is not the same as barrels come back. You are going to have lower output originally. You also have extra demand now with inventory replenishment, so I don't expect prices to ease much from where they are. Also, because storage tanks are hitting their full physical capacity, floating storage is being used. So you've got tankers sitting out there all full of oil. So even if the Strait opened today, guess what has to happen? All those full tankers have to go deliver and drop their load first before coming back. So you're looking at round trip minimum 45 days up to 70, 80 days before the empty ships can get back there to fill up. So the full ships must deliver first. Also, companies, even if it opens up, Iran now knows they can use it as a weapon. Companies may be hesitant to send their tankers back in for fear that, they've closed it again. Hostilities have started up. Somebody fired a missile and they closed it again. Now my ship is stuck behind those lines for some time. Insurance companies might say, nope, we're not going to cover it just yet. So even if it opens, there's no guarantee that everything can return to normal. There's no guarantee that empty ships will show up and say, give us some of your oil. So you'll be at physical capacity for some time, which means you're going to have shut-ins, which means you're going to have some loss of recoverable oil, some permanent loss of recoverable oil. And then you have also higher or no insurance coverage, which is why I've started selling the puts at the 80 to 75 range. I would love to see a nice drop down in oil towards that price. On some hope, because the market prices in hope well before reality shows up. Semiconductor index up 100%, and then reality was good, but certainly didn't match the hope. And I think the market would do the same thing with oil. Okay, the Strait is open. Hope drives WTI down to 80, maybe 78, 77, but the reality is not going to match the hope. At least that's the bet that I'm making. Okay, let's have a quick look at S&P 500. We had hit a new all-time high earlier in the week, 759.63. Same with QQQ, 746.07. IWM still holding its all-time high from last week. And then Friday, look at that big red drop down. But, in all reality, that had to have some kind of profit taking involved with it. What is interesting here, let's just get this out, and we'll just draw a line of support under our trend here. And this is sort of what we have been traveling on, that if we head on back to the line of support, we're at 734, this would suggest somewhere around 712 off of 759. We are 2.9% now below the all-time high. Correction is 10%. I don't know, with the buy the dip mentality that we have that has worked for 6 years now, I don't know that we get to a 10% correction after having seen what was close to a 10% correction back here. I just think that this was a lot of ridiculousness. IWM down 3.46% from its all-time high, and QQQ more than halfway towards a correction, 55% of the way towards a correction. Forward 4-quarter operating earnings higher again this week, 351.69, closing SPX 73.83 gives us a 21 times forward multiple, down from 21.61, and with a lot of volatility, 61st percentile for the last 13 weeks. Last week was 0. Nothing to see here, folks. Well, there we are. IV last 15.9%. You can see that right at the very end, that spike up from close to about 12% up to 16%. Wednesday, we have Oracle reporting earnings. Thursday, Adobe, and we get some look into the housing sector. We have Lennar. Is this over? Is the selling over? Hard to say with things like this. Is the bull run over? I don't think so. I think if we do have selling, I think a worst case scenario would be approaching a correction. Usually when you have big down days like this, It usually just doesn't flip and turn around in one day because it spills over into other markets that open up. You have the Asian markets that will be opening up later today. As I do this now, it's 10:36. We're not going to have any visibility till later on. I'll be checking in on Hyperliquid this afternoon, seeing where it looks like futures want to open. But I have seen weirder things. This market is schizophrenic, to say the least. Everything looks bleak and dire, and suddenly it's like everyone got the memo but you, and suddenly everyone can't buy enough. So who knows? All you can do is be prepared to say, if we have more red, here's what I'm going to do. If we have more green, here's what I'm going to do. But if your positions are down, which they would be, because the market is down, that I don't think is a reason to say, I got to get out, I got to get out. I don't think this is over. I think this is just a normal reaction to the abnormal overreaction to nothing being solved, if you can follow that logic. Okay, our spotlight company this week is Gen Digital. Maybe some of you know it by some of its brand names: Norton, Avast, LifeLock, Moneyline. They operate in two segments: cyber safety and trust-based solutions. Market cap $15.83 billion. I have a 2-year chart up. Certainly not as impressive as some of the cybersecurity firms we've looked at. Cyber safety is a different thing. It is cybersecurity basically for the individual, but with much different economics. So we'll go through that. I do have a reading that I wrote up and I compiled for this one, mostly around, I wouldn't say around Gen Digital, but everything you need to know about how you would think or analyze Gen Digital and also any other company in this space. One of the things that jumps out at you when you look at this company is there's always the question of, well, why would I pay for any of this stuff? My operating system certainly protects me with virus scanning and malware detection. I mean, I get that. If I'm using a browser, there is stealth mode and VPNs within the browser. What do I need to pay for that stuff for? And that is touched upon as well. I have the document which will be put on the site in the applied analysis. Trouble is, where do I stick it? Because each one of their segments operates in a different sub-industry. So is it communications? Is it financials? Or is it technology? Right? Is it a consumer service? I'm trying to figure out where I would put it. I can also put it on Gumroad, but I'm not sure if there's a lot of interest in consumer cyber safety. So as we go through it, you'll let me know. Just put a comment below if you would want me to put the PDF up on Gumroad. I will. But if I don't see that there's much of a demand for it, I'm not going to go through the process because it is time consuming to prepare a document for that. Fiscal year 2026 revenue was up 27% year over year, but there is an acquisition in there, so that's not organic. Gross margins, look at that, 84%. Every paid subscriber they get almost goes all the way through to gross margin, so we judge their success and their future by the growth in paid subscribers, because once you have your fixed costs covered, you have really nice gross margins. Operating margin of 51%. Cyber safety has 61%, but trust-based solutions about 30% operating margins, and trust-based solutions is the faster growing segment right now. EPS of 256, up 15% year over year. Also the 10th straight consecutive quarter of over 10% growth in EPS year over year, not quarter over quarter now, year over year. 10th consecutive quarter that EPS year over year was above 10% growth. On a trailing 12-month basis, based on their price, they're trading at 10.3 times trailing PE, fiscal 27 guidance. We've just done fiscal year 2026. Revenue increasing 8 to 10%. EPS mid-range 290 puts a next 12-month or a forward PE at 9.12. And they do generate significant cash flow. Here is their segments broken down: cyber safety and trust-based solutions. Let's see if I can write on there: cyber safety, trust-based solutions, and then of course your corporate overhead. Looking at cyber safety from 2024 to 2025, increased 3.89%, 25 to 26, 5.13%. And again, for many of the things in here, there are free versions already out there. However, there are freemium models available from these companies. 500 million is the number that Gen Digital reports for the number of subscribers that it has. 79 million of those are paid. So you offer it free, and everyone else has it free, so offer it free, and you hope to upscale them, saying, let's move you to the next tier. You have these things for free. How would you like these extra things? And the success of the company is how well they migrate from the top of the funnel, from the freemium to the paid side. For trust-based solutions, 2025 over 24 was an increase of 2.15%, but there's your big jump there, is 118%, but again, that is because of an acquisition, the Moneyline acquisition. For operating income, 24 to 25 increased 45%, 25 to 26 increased 31.7%. So let's learn a little bit about cyber safety and trust-based solutions, and then let's look at more company-specific ways of how we would judge their success, which is very different from how you would judge the success of a enterprise cybersecurity company. Okay, let's start with the difference between enterprise and consumer. For enterprise cybersecurity, sold to a corporate client, and it is a long process, multi-year sale, long lead time, so that requires a dedicated sales force, and the sales force is more technical, and very high switching costs. Once you're a client of a cybersecurity firm, switching to another one is not an easy thing. Companies compete on technical capability, the integration depth, and security research strength. Customer concentration is quite common. Priced by seats, endpoints or data volume, critical metrics here: net revenue retention from existing accounts, the remaining performance obligations. We get into consumer cyber safety, sold to individuals or households, annual subscription as opposed to a multi-year sale. So you're still going to have some contracted liabilities or deferred revenue. Gen Digital calls them contracted liabilities. Your customer usually has no technical training, so marketing to them based on technical features is a mismatch. Their purchase is often fear-driven. For enterprises, it is just simply a line item that they have. For consumers, it's not until they hear of a big breach somewhere, or an attack on something, or a new scam, where they start saying, oh, I better protect myself, and requires marketing efficiency. Here, dedicated sales force, here you're going to get them into the free side, and then you want to convert them. So we do have to measure how efficient their marketing is, because if they're spending just as much money to get a customer that pays just as much money, they're really just trading dollars. So we're going to look at lifetime value of the customer versus customer acquisition costs, and you do have to dig to get these numbers, but I have one screen where I get all the numbers for you. They compete on brand recognition as opposed to technical capability. Brand recognition, perceived trust, and big one here, ease of installation, ease of use. Renewal is automatic. You sign up and it just hits your credit card every year. It just renews you, off you go. Typically high churn rate, and the churn is mostly through inattention, where At the end of the year, you either don't renew, maybe you have to click a button to say I do renew, you're not on automatic renewal, or after a year you say, you know what, nothing's happened to me, I don't think I need it. But that's the point, right? You know that it's successful when nothing happens. Or do you say, well, nothing has happened, so what am I paying for? Because you can't see the counterfactual. So either nothing truly did happen and you're just wasting your money, but we spend money on insurance, so that's sort of the same thing. Low switching costs as well. Price by devices or by feature tier. Critical metrics. Growth in paid subscribers. Average revenue per user. This is probably, these two here are probably the big ones. Retention of paid subscribers. This is critical. And efficiency of paid marketing. Let's see if I can move forward here. There it is on the other screen. Slide 1, slide 2. 4 pillars. And Gen Digital has all of these. Threat protection, number 1, and their brand here, Norton, is the largest by revenue. Antivirus, anti-malware software, real-time scanning, firewall functionality, virtual private network services, but your browsers have these as well. Secure browsing, password managers, and increasingly the detection of phishing and scam attempts in emails on the web. And it's meant to prevent harm at the device level. Identity protection, this is their LifeLock brand, second largest by revenue. They detect, alert on, and help remediate the misuse of a customer's or a consumer's personal information across financial accounts, public records, dark web marketplaces, and credit bureau files. Monitors for harm at the account and credit record level. So here's your device level, here's the account and credit record level. Online privacy, smallest by absolute size, but fastest growth rate. Attempt to limit the collection, distribution, and resale of consumers' personal data by third parties. I like this idea because I feel that I'm profiled online. I know there's probably data brokers out there that have a pretty good profile of what I do because of the subscriptions I have, what I buy online. I tend to buy business class when I fly across the carriers that I fly, and I'm sure there's some place somewhere. Apple probably contributes, says he buys the most expensive iPad, the most expensive iPhone, because I buy it all online. So when I visit Amazon, it says, oh, this guy. Okay, this guy. So I would like all that cleared out. I like this idea. 2 largest subcategories. Data broker removal services. I like that. Submit opt-out requests to the hundreds of commercial data brokers that compile and sell consumer profiles. I guarantee you I'm being sold out there. Tracker blocking technologies which prevent the building of behavioral profiles during ordinary web browsing. I think I like that idea. This is something that I would look at. I'm more than covered, I think, on threat protection. And I don't know that I'm fairly well covered over here, but with Apple, I'm fairly well covered here. Protect the consumer from a more diffuse and continuous loss of information control. So you can see how these are all targeting different things. You're targeting the device level over here. You're targeting the account or credit record level here. You're targeting the individual over here. And there is one more category here. Reputation. Smallest by revenue. Help consumers monitor and influence what appears about them in search results and on public-facing websites. For the average household, not really. Buyers often small business owner, a professional whose career depends on online presence, or a consumer who has experienced a specific reputational incident, often sold as a concierge service rather than self-service software subscriptions. The leading vendors, and this is Gen Digital among them, offer bundle suites that span all 4. So there's the land and expand strategy that we've seen in enterprise software also applies here. Is get you for free, see if I can't get you into identity protection, and from there cross-sell you to the other platforms by offering bundled services. The cyber safety spending, consumer spending on cybersecurity accounts for about 10 to 12% of total cybersecurity spend. The enterprise is the biggest one, also the fastest growing one. Grows at a slower pace than enterprise, about 8.9%, the estimate for cyber safety, 8.9% CAGR to 2035 versus 13.8 for enterprise. So if you are making a bet that the world needs more cybersecurity, enterprise has the largest growth rate and the largest share. Consumer 8.9% and is a smaller share. So if you are putting money on the factor, on a safety factor, enterprise wins. But enterprise, you're paying the multiple. You're paying big multiples. Here, for Gen Digital, as we've seen, the forward multiple is about 9 times. Let's move over. There we are. Demand, driven by fear rather than productivity, triggered by external events rather than internal planning. From targeting the device, this is what their products do, targeting the device, protect you from viruses, malware, to targeting the individuals from phishing and ransomware. AI. AI means we're moving into a far more dangerous world. Same thing for the consumer. Lowers the cost and raises the sophistication of attacks. We no longer have to worry about an email from a Nigerian prince asking for our bank account number so they can wire money into. Deepfake audio and video. So that if I know that you have a grandson or a granddaughter and I can get their voice offline somehow, I can get AI to imitate their voice and to call you up and say, it's me, I'm in trouble, I'm going to need $500, and you on the other end of the phone would hear that voice or even send you a video. Deepfake audio and video, personalized phishing, synthetic identities. I know there are people out there pretending to be me, having conversations with people saying, listen, why don't you invest some money with me? I can help you, grow your portfolio. Here's where you can send and it's all a scam, but, they're pretending to be me. Purchase has 3 distinct behavioral features. Fear motivated. Buyer buys on trust and the value of the product is difficult to perceive. Since it's fear motivated, it's event driven. The higher profile of breach, the greater the demand. We have a paradox here. As enterprise security gets better, Mythos has been released to Palo Alto and CrowdStrike first, and some companies to secure themselves against attacks. Let's say you get to a world where enterprise security is so tight that it's difficult to breach. Then you don't have these fear-driven events. You don't have these big stories about this breach and that breach, which means the consumer then says, they're not highlighted to the fact. However, the criminals aren't going to stop. If they say the bank is too well fortified, let's break into the houses. And that would be the next stop, which means the less you hear about enterprise, that means that pot of gold is gone. They're coming after you because the criminals aren't going to say, you know what, we had a good run. Let's retire. As enterprise security gets better, fewer breaches are newsworthy. Less fear-driven demand from households, the more the consumer becomes the remaining viable target. It's something to think about. I don't think that we're going to be done with the breaches, but just think about that if it did get that good, if Mythos can secure your site such that it cannot even break your site, then the other side can't break your site. What's left? Can't break into the banks, you got to break into the houses, right? Buyer buys on trust, brand, and familiarity. Technically unsophisticated. Technically, they cannot evaluate the product on its merits. Established brands is a durable advantage. We've all heard of LifeLock. We've all heard of Norton. Value of the product is difficult to perceive. Purchased to avoid negative outcomes. So if no negative outcomes arrive, do you think, well, it's worked, I have no negative outcomes? Or do you think, what's the point of paying? I never get any negative outcomes. Beyond the event-driven pattern, the band runs a slower and more reliable current. The steady expansion of digital life into more of the household's activities. There was a time when you, down here, household, where you had a single family computer. You now have multiple smartphones, tablets, laptops, connected home devices. If you use Nest facilities, if you have a doorbell cam, smart appliances, each a potential point of vulnerability, and each a justification for broader multi-device protection. Each additional device, each online account, each digital payment method, each connected appliance enlarges the customer's attack surface, and you start getting autonomous driving vehicles and robots into the house over the next 10 years. The household does become a ripe place for target. We only have 7 slides. That was number 4. Now number 5. Revenue is recurring and subscription based. Billed in advance. This is important. It is billed in advance. When we start looking at how much is spent on sales and marketing, you're going to see that the money that comes in, and it turns over very quickly because most contracted liabilities are short term, that the subscription money that comes in basically funds the marketing and advertising. This sets up deferred revenue or contracted liabilities. Gen Digital on their balance sheet has almost $2 billion of contracted liabilities. 1.977 billion of 1.904 is current, because subscriptions are usually for 1 year, right? So if it's all paid in advance, you would have most of your contracted liabilities which are current. Now this is sitting on their balance sheet under liabilities as almost $2 billion, but the true cost is only about 20% of that. So the true liability associated with that contracted liability is the cost of delivering the service. They have gross margins in the 80s. So even though it says $2 billion as a liability, you have to back out 1.6 billion of that and say, look, 1.6 billion is gross profit that are sitting here. It's just an accounting issue that they cannot recognize that revenue yet. They have to recognize it ratably over the next 12 months. But as they recognize 1/12 of this, they are getting new customers, which then re-add to this. 79 million paying customers that they have so far. Freemium model, common, particularly in threat protection. So acquisition, top of the conversion funnel. Conversion rates are typically low single digits. This is very common. If you offer something for free, you'll get 100 people using it. If you try to convert that now to sales, usually you're anywhere from 2 to 8%. 2 is telling you that that's the bare minimum, and that is, an average company with an average product. If you're a good company with a good product or good service, good reputation, you can get as high as 8%. Seems low, right? That a lot of people will try it, but when you actually say, okay, let's start paying now, you'll actually get far fewer. And this works the same way with surveyed intentions, which is why I don't like those kind of surveys. Is if you survey people, say, would you pay $20 for this service? And 100 people say yes, and you say, okay, well, here's $20. You probably still only get, anywhere between 2 and 8 of those people actually paying the $20, even though they said that they would pay $20 for it. They didn't really mean it. So there is a difference between an intention, saying I would, and actual action, and it is a big gap. But it still is the best way to get customers, is you offer it free at first to get them using it, and you hope that you can convert them into some sort of paid subscription somewhere. Gen Digital says they have 500 million users and 79 million that are paying. So you can see that that's only about 15%. Close to 15.8% are actually paying out of that 500 million. The free group, they're not completely useless, though. It is a strategic asset, because the freemium model, remember, it's in threat protection. So what are they seeing? They're seeing attacks on 500 million. So they have huge data sets, 500 million, that they are learning from. Every device running the product, free or paid, is a sensor that contributes data on emerging threats. So anyone in the 500 million that gets hit helps protect the 79 million over here that are paying for it. A larger installed base sees more attacks sooner and feeds a richer stream of intelligence back into the detection engine, which improves protection for all users. So we don't look at that 500 million and say, well, what a waste of money. It's all part of your customer acquisition cost. But you're also getting something out of it. It is an asset, and it is a big moat that somebody that's just starting up in this is not going to have those numbers. Creates a genuine network effect in the quality of protection and is one of the few sources of durable competitive advantage. Cannot build a durable subscription business by charging for a function consumers can obtain at no cost. And like I said earlier, I can get a lot of these things at no cost. But I'd have to go across a bunch of different companies to piece them all together. Standalone antivirus subscription is exposed to free substitution, faces persistent price and retention pressure. So the category is migrated from single product offerings to bundled suites. And this is, I can get this for free over here. I can get something else over here. I can get something else over here. But what they do is they say, well, we'll give you all of this stuff plus a whole bunch of other little stuff in here that you really can't find for free, and we'll bundle that service. Combines threat protection with identity monitoring, a password manager, a VPN, privacy tools, credit monitoring, all in one stop. Slide 6. There we go. Distribution, direct-to-consumer marketing. There are a number of channels, direct-to-consumer marketing. OEM pre-installation is not the dominant channel it once was, but when you historically bought a PC, you get a whole bunch of preloaded software on there, and you had like a 30-day or 90-day free trial of it that was already preloaded. So it gets it in front of you. Partner and embedded distribution bundled into the offering of another consumer-facing institution. Telecom carriers, for example, internet service providers bundle protection of the service plans. Banks, insurers, and financial institutions offer identity protection to their customers, often in response to their own breach exposure or as a differentiating benefit. I've had this before, where your bank sends you an email saying, this happened to us. None of your data really was exposed. But we are offering a 3-month free subscription to this identity protection service. And it is the identity protection company that approaches the bank and says, listen, when you have a breach, why don't you just offer our stuff? And they make a deal that way. And this way here, I at least start to use it, and I may convert into a paid subscriber. Typically carries lower direct acquisition costs and can deliver large volumes of subscribers efficiently. But it shares margin with the partner. Another form of distribution, employer or affinity channel. Affinity means you're part of a group. You're part of some organization. Identity protection, in particular, is offered as an employee benefit or through membership organizations. Once a customer has been acquired, the primary lever for growing revenue from that customer is cross-sell. So you get me on identity management, and the idea is you're going to sell me on some of the other services that you have. And Gen Digital is now getting into something called financial well-being. Looking at the idea that, listen, we're protecting you in a lot of places. We protect your device. We protect your different accounts. We protect you as an individual. Maybe we can protect your money. The sale of additional pillars and higher tiers to existing relationships. 2 engines of growth: net subscriber growth, which we're going to see that Gen Digital is quite effective on, and average revenue per user growth. So if you have 10 million users and you can't grow that, maybe you can grow your revenue by 5% by charging each of these 10 more. What you'd like to do is have the multiplication of 1 plus your net subscriber growth multiplied by 1 plus your ARPU growth, so that your revenue increases faster than any one of these two. I've done a whole screen for you on this. Let's go through Gen Digital. They don't report the numbers for you. You have to pull them apart. And they used to report some numbers. They used to report churn, but they've since dropped that off. So we sort of have to try to guess where churn is. But their churn is fairly stable. Let's see if we can recover the revenue growth by decomposing it into, well, what was your subscriber growth and what was your revenue per user growth? So the revenue growth year over year was 27%. That is not bad. Subscriber growth. They tell you they have 79 million paid subscribers. Last year, year end, they had 68. So 16.17% of your revenue growth came from subscriber growth. Jen calls them paid customers. They are running about a 77% retention rate. This is from fiscal year 2025. They make no mention of it in fiscal year 2026, but I did find an analyst who seems to think it's 77% or use the 77% number for churn. Now, maybe they say it on their conference calls. I don't know. I didn't listen to their conference calls, but it's not in their investor presentations. It's not in their 10Q or 10Ks. So maybe somebody asked on the call, but I didn't listen to the call. But I use 78%, which means I got a 22% churn. If you take 1 divided by churn, you'll get customer lifetime. 1 divided by 0.22. Customer lifetime is about 4.54 years. If there's a 22% probability that I fall off every year, it approaches 100% in 4.5 years that I would fall off. Lifetime value. Undiscounted lifetime value is your average revenue per user times your lifetime amount times your gross margin, and we'll calculate that below. 2026 average revenue per user was $63.29. We take the $5 billion divided by the $79 million in 2025. It was $57.87. We take a revenue divided by paid subscribers. So your growth was 9.37%. Can we recover 27% from this? So we have 16% and 9%. So 1 plus the 16% multiplied by 1 plus the 9% minus 1, 2706, 2706. So there we go. We've been able to break it down ourselves. Because we have the numbers to break it down, and we really only had to make a guess at this, and we just assume stability in their churn rate. Why they wouldn't give it to us in the investor presentation seems odd to me, when this is the method you would go through to evaluate how well they're performing. You would go through this. Why they don't just give it to you? Curious. Let's look at how efficient they are in getting customers. Sales and marketing expense was $1.228 billion for the fiscal year. How many customers did they get from that? Well, if they have a 22% churn, they started the year with 68 million. They lost 14.96 million just from churn, which means they must have added 25.96 million. This $1.2 billion spend must have been to get 25 million, because they ended with 79, started the year with 68, so we know they got 11, but they had to replace this 14 to get net additions, or this 15, so 25.96. So the customer acquisition cost is sales and marketing divided by the new customer add, $47.20. Lifetime value, the undiscounted lifetime value, is how many years we expect them to last based on that churn rate. The average revenue per user, and this is without any growth at all, it's just the current revenue that they're experiencing now, multiplied by a gross margin, 225.44. We multiply by the gross margin because this 1.228 comes in below the line, below gross margin in operating margin. So if we took it as multiplied by its operating margin, we would be counting sales and marketing twice. A better way to determine it would be to just re-add or remove sales and marketing from operating expenses, and then taking that adjusted operating margin to figure out what the lifetime value is. One more calculation here. You take lifetime value divided by customer acquisition cost, 4.78x. Now, if you change your retention rate from 78% up to 80%, what it does is it lengthens your lifetime the customer lifetime. If it lengthens the customer lifetime, it increases the lifetime value. So just something simple like reminding your customer of the value they're getting and trying to reduce the amount of churn. The churn is the big thing. If you go from 78 to 76, it shortens that lifetime value and will decrease this number over here. Another good metric is the acquisition cost payback. It's costing us $47.20. How long does it take for us to get that money back? Well, we'll divide it by the average revenue per user, $63.29, but we do have a cost of getting it, so we subtract our cost of revenue. In other words, multiply by the gross margin. $47.20 divided by that is 0.95 years. It takes us basically 1 year to get our money back. So if we get a customer that churns after the first year, we've really just traded dollars. We've made almost nothing on that. We really hope to have them, or at least Gen Digital hopes to have them for multiple years. Contracted liabilities, also prepaid revenue, $1.904 billion. This is all current. Last year was 1.846. Again, all current. So if you think about, well, you spend $1.228 billion in sales and marketing, but you're going to recognize this 1.94 this year, and you're going to bring in, call it another 1.9 billion over the course of the year. As customers are coming in and paying for the year, all of that pays for the sales and marketing. So the cash flow just from that alone pays for your sales and marketing expense for the year. Bookings to revenue. This tells us whether a company is growing or not. Bookings mean I've got this many customers that came in. However, because I cannot recognize all the revenue right away, I have contracted liabilities. Are the bookings I'm getting greater than the revenue that I'm realizing? Because you can think of your contracted liabilities as your reserves. Call it reserves of oil underground. We know that a company that pulls oil out of the ground will have lower reserves at the end of the year unless they can replenish those reserves. So what we can calculate for an energy company is the reserve additions to production. So if you're adding to reserves 1 million barrels a year, but your production is 1.5 million barrels a year, that ratio is less than 1, you are depleting your resources. But if you're adding 1.5 million barrels of oil and you're producing 1 million, you are actually increasing the value of your asset, which is your reserves. Is this company got a ratio higher or lower than 1? So we take bookings to revenue, and they do report bookings. Bookings of 5.1 billion, revenue of 5 billion, 1.02. Last year, bookings to revenue was 1.013. So they actually improved that year to year. So they're actually growing in their bookings as fast as they recognize the revenue, because it is 1 year. Their bookings are increasing. These are not blow the door off numbers, right? 1.02. When we look at net revenue retention for SaaS companies, we want to see it somewhere up around 1.2. This is 1.02. It's not quite the same number. It's measuring different things, but it's getting at the same idea: is are we growing? So that is not too bad. Now you can get all of these numbers from the presentation and from the balance sheet without much difficulty, but you do have to know what you're looking for, because it doesn't tell you what average revenue per user is. You have to calculate it. It is not telling you what its customer acquisition cost is. You got to calculate that. You have to think about, well, how do I measure the success of this company? These are the metrics you would look at, and quarter over quarter you want to see that these metrics are maintaining or improving. Once these metrics start degrading, you're not going to see it in revenue right away. So if you just look at the income statement, you're looking at revenues and margins, it's not going to show the deterioration that's happening behind the scenes until a couple of quarters later, because revenue for these companies are lagging variables. The metrics I've shown you up here, these are leading variables, so you would track these quarter after quarter and look for an upward trend, at least a stable or upward trend in these numbers over time. And that takes us through cyber safety and trust-based solutions. And with that, you should have a much better understanding of Gen Digital. Good solid cash flows, very low PE, but it is not a company that you're going to buy and get a 30% run over a period of 3 months. That's just not what's going to happen with a company like this. So this is probably why it's only trading at 9 times forward earnings, is because it is considered probably more defensive in this sector than growth oriented.